Hi, this is Joan Norton. Today is May 9th, 2013. Thank you for joining me for my webcast. Those of you that are clients, hopefully those of you that are friends of clients that are listening to this webcast. I do these periodically just to update people and take a review of where the economy is, where the market is, the stock market, what might we be looking for to see in the future, etc. So thank you very much for joining me this morning. Right now, we're looking at a market high of 15,100, but we'll see what happens after that. I was very fortunate. I went to the Berkshire Hathaway annual stockholders meeting Saturday, May 4th, 2013 in Omaha, Nebraska. Just full disclosure, so everyone knows what they're looking at, that's Warren Buffett on the right-hand side, and that's me on the left-hand side in the picture frame. Okay. As many of you know, Warren Buffett has been called the Oracle of Omaha. He seems to be doing pretty well in terms of the ups and downs of the market. He's been doing it for years and years. And we'll talk a little bit about some of the things that I heard at that meeting. Interestingly enough, the only people in that meeting, 30,000 shareholders, no media. The media was outside. There was no recording. There was no videoing, none of that, okay, audio or video, whatever. So it was just the shareholders, and he and Charlie Munger. Warren is 82. Charlie Munger is 89. They were on the stage by themselves, no notes. The meeting started promptly at 8. It ended at noon for lunch, 1 hour, and then he went back, he and Charlie, from 1 to 3. Again, no notes. Answered questions, talked about what he saw the future was going to be, etc. So an incredibly brilliant man, and he has one of excellent qualities that's missing, in my opinion, called common sense. So that's one of the reasons why I feel he does so well in the market and in looking at what the economy has come from and where it's going in the future. Okay, so let's talk about that. We prepared this a little ahead. This is dated 5/7/2013. As many of you know, last night the market closed at a record high of about 15,100. What the heck's the market? What am I talking about? This is the Dow Jones Industrial Average. This is the 30 largest United States companies. Okay, General Electric was on the original Dow 30. It's the only one that's still on the Dow 30. So things have come and gone, but GE has always been there. IBM is here. Procter & Gamble is here. So this is an indication, these 30 companies, of how the economy is doing. It's sort of a temperature of what is occurring in the United States economy. So let's take a second and look at this. I don't have this because I'm showing a 10-year period, but off chart to the left, of course, is 9/11. And that sank like a rock. We all know that. And I wonder why. We were under attack. But here we are. We start in 2003, and we show the ups and downs. Please look at 05 to 06. You'll see, the up and down, somewhat of the normal situation in the market. Then all of a sudden, right after 07, things got a little nuts, basically between 07 and 08. No matter what it was, the market went up. Now, this was in face of 2 wars, one in Afghanistan and one in Iraq. Also, the banks and the government felt if you could basically fog a mirror, you could have a mortgage, you could own a house. So things are a little nutty, and many of you know you had friends that bought real estate in Florida and it doubled in value in a month. Crazy situation, one that no one should understand that this is going to continue. Nuts. And many of you were clients and met with me, and I told you it was a very troubling time. I was very uncomfortable seeing this. So what happened, after that? Well, the market went down because it was based on dreams and fluff, in my opinion. not on reality. The market, in my opinion, should have been around 11,000. I'm looking from '08 to '09 now. Okay? It should have been around 11. But we have a media, in my opinion, that is yelling fire in a crowded room. So it continued to drop, and now we're seeing the beginning of '09, and the market's at 6,000. So it has gone from a high of 14,000 to 6,000. Now, the media said the following: it will take decades. It will take decades to go back to 14,000. Decades usually means more than 10. Decade is 10, as we all know. Decades should mean 20 years or 30 years, right? Plural, decades. Well, it appears that the decades were 3.5 years. So again, the media was wrong. And those people that are listening to the media will continue to be wrong. We already know, regardless of what the news story is, they usually get it wrong. Okay? So here we've got 3.5 years. The market basically is back up to 14. And oh yeah, guess what? It's cruising on up beyond that. That's what's happened in the past. Will that happen in the future? I don't know. I can talk about the past. I can tell you information that I have, but no one knows the future. We obviously have problems in the world. We have situation in North Korea. As I'm talking now, we still have problem with Syria. And then we have a situation that's really quite bizarre of young men running around with their mother's pressure cooker making bombs and causing incredible pain and harm to people for no reason other than, I guess, they think there's 72 virgins on the other side waiting for them. Let's talk about the S&P 500. These are the 500 largest United States companies. Okay, previously we talked about the 30 largest. Now we're talking about the 500 largest. We're looking at that same time period, '03. You can see how it goes up and down. Again, we see a big down in '09. Horrible. It went from a high of 1,600 to about a low, pretty close to 600, 700. An enormous drop. Okay? And if you had sold then, you would have experienced that drop, that pain, that loss. Then we see the market slowly crawling up, and at the moment we're around 1,600. And again, this is the 500 largest United States companies. We also have something called the NASDAQ. The NASDAQ is primarily technology type of companies. There again, usually these companies are smaller, but not necessarily. There again, we see, the up and downs, and we see again a horrendous situation in '09. It had gone from a high of around a little over 3, right around 3, then down, and now we're seeing again the jaggedness, but now it's up to 3,500. So again, if you had sold out at 2,200, let's say, in '08, and you bought then and you sold out at let's say about 1,000 in somewhere in '09, you would have experienced tremendous loss. Okay, tremendous loss. But again, this is not money you should be investing to pay your electric bill or the trip you're planning in 6 months. This is money for retirement. This is money for college education for kids. Things that are long range plans of yours. What we do is we fit your plans. That's what we take. And then we see what we can invest in to make those plans come true. You don't fit into the market. The market fits into your plans. Okay? So, what did I take away with the Berkshire Hathaway meeting that we talk about? Again, just so everyone's clear, I'm the one on the left in the two-piece suit with the briefcase, listening to Warren, who's on high, the Oracle. He's on the right. And the takeaway is buy low, sell high, and stay diversified. That is the meaning of how to invest. It's interesting. they were talking about, gee, Mr. Buffett, what made you decide to move money out of cash? And he's got billions and trillions of dollars in cash, and purchase Heinz ketchup because he recently purchased Heinz. And he said, my money is making nothing in bank accounts. He said, so I took a little bit of it and I bought something that'll probably always be around, ketchup. And in fact, he said, ketchup is forever. And when you think of ketchup, most people think of Heinz. Those are the kinds of companies that Warren buys. Okay? He buys Coca-Cola. He's one of the largest shareholders there. So it's Procter & Gamble. We'll always need toilet paper. It's IBM. It's companies that are always going to be around, and they pay dividends. And that's one of the reasons why you're seeing the market go up, because interest rates are a historic low. Where are you going to put your money where you're getting some return? Well, if you go into some of the things that we call blue chips, these are blue blood companies, like the Heinz, like the Procter & Gamble, they spin off dividends. They have dividends. And that, in many cases, you're getting much more than you would in a bank account. So the interest rates are going to stay low, according to Ben Bernanke, and he's the chairman of the Federal Reserve. And if they do stay low, he said he's not even going to look at interest rates till 2015. Where are you going to put your money? You can't put it in real estate. It's not liquid. Maybe I'm going to take a chance on mutual funds that invest in things like the S&P 500, the Dow Jones, and I get those quarterly or monthly dividends, depends. I get those reinvested. My time horizon's longer, so I can afford these little bumps that I'm going to get. I'm going to stay in the market. I'm not going to be panicked by the media. Maybe I'm going to think like Warren Buffett. Okay? So let's think like Warren Buffett. And here we are here, and we're looking at different time horizons. And again, I advise you to check all the reference points about footnotes on the bottom where I got this particular information. We're looking at rolling averages, and we're looking at sort of crazy time periods. We're looking at August 31st, 1929, and August 31st, 1939. Okay? And then we're looking at, on the right-hand side, we're looking at a rolling period of September 30th, 64 to September 30th, 74. And you can see here on the right-hand side, we're looking at the 10-year returns, and on the left side, we're looking at the 10-year returns. And on the bottom there, where it says average, on the bottom left, you're seeing 15 almost and a half, and on the bottom right, you're seeing 15 and almost 3/4. And the reference point that we're making here on the bottom, the footnote, it's a look back at history, okay, of the stock market. And this is the S&P 500, 500 largest United States companies. And it's showing what happens after these big dips in the past. This is what happened. Even after 3 steep drops, the S&P 500 still provided an average 10-year return of nearly 11% as of December 31st, 2012. And we point out here, it's important to note that past results aren't predictions of the future. Absolutely. But this is what you need to know about history. You need time, okay? This isn't to pay the electric bill, but for retirement, some long-term goals, this is what you need to look at, in my opinion. Dividend-producing stocks, okay, that you can purchase as mutual funds. Again, you're going to have those ups and downs. Stock market is the only place when things are on sale, no one wants to buy. Every other place, if you go to a supermarket, Bumblebee tuna's on sale, 3 cans for $1. You can't buy enough of it because you know you're going to use tuna fish. Only in the stock market do I want to buy high and sell low. Exactly the opposite of what Warren Buffett says. Okay? So again, what are your plans? Then how can we make your plans take the capital markets of the world, not just the U.S., we've been focusing on that. Shortly we'll focus on the world, and work to your advantage. So let's talk about the interest rates. here we're seeing '07, '08, and I'm looking worldwide here. I've got Britain, the United States, Japan, the euro. You can see where things are going. Look to the right. Interest rates are virtually zero. If you doubt that, go to your bank. See what they're giving you for a CD. Go to just the regular Google it. What is the return, the interest rate you're getting on a 10-year treasury or a 10-week treasury bill? Those are treasury bills from the United States government. Very low. So if you have inflation at 3%, what's inflation? I can explain it very easily. What do you pay for a gallon of gas? That's inflation. Everything is transported in this country, unfortunately, by truck. So that's added, whether it's a head of lettuce or a dress that you're buying or a piece of equipment or whatever, there's a cost to transport that. One of the things Warren Buffett is doing, he's buying a lot of railroads because he sees that as the future, because that's a cheaper way of transporting goods. Anyway, that's inflation, and that erodes your money. And again, if inflation is 3 and you're getting a half a point, you're going backwards real fast. And the Feds, as I said, they're not even going to look at interest rates till 2015. So you need to think about, how am I going to keep my purchase power, which is really what we're talking about, in the future and in the moment. So I've talked a couple of times, we've talked here about, obviously, U.S., what have you. And in previous webcast, I talked about the developing market, the developing world. What am I talking about? I talked about Africa. You can see some of these things here. Latin America, other Asian countries, India and China, of course, we know where they're developing, actually, definitely into, economic superpowers now. We've got this growing middle class. And guess what, everyone? They want to be the middle class, like the middle class in the United States. In the most recent Economist, they were talking about China, and they were talking about the China dream. It's all over everywhere, the China dream. And they've patented it really based on the American dream. They want a middle class. They are now traveling. They are seeing what we have. They want it too. Big surprise. Okay? And what we're seeing here is we've got China, they're black on the bottom, then we've got India, but we're also seeing the growth of Latin America, other Asian countries. They all are looking for that American dream. They might call it something else, but they want the goods and services. They want a better life for their kids. Okay? So that's what's coming about. And the middle class that's consuming goods and services, that's growth. Let's talk about the emerging global consumer, and let's talk about just one part industry here. One area that everyone can agree with. Healthcare. Okay? Look at 2011 to 2017, the pharmaceutical sales growth, what they're predicting. Okay? Where we're talking about emerging markets, we're talking about a 72% increase that we're potentially looking at. Whereas established markets, that would be the U.S., let's say Britain, etc., we're looking at 28%. You're seeing what pharmaceutical sales were in 2011. That's on the left-hand side. And way on the right-hand side, you're looking at 2017, and you can see where the pharmaceutical sales are going there. Huge jump, okay? You can see where the data came from down at the footnotes. Again, please look at these footnotes. This is where I get the information from. But again, this is what we're looking at. China, particularly, they have an aging population because for a long time they had a government policy of only one child per family. And that's not a replacement of the existing population. So the problem there is you have a lot of people getting older. Obviously, they're going to need more health care, etc. So they're going to have to be addressing that probably within the next 5 years, much more so even than the United States. And again, we've talked about this in the past, but I'm just reiterating this. What does this mean to you as an investor? This is the future. This is where things are going. Problem is, when you have development and growth, And we're looking at China, and we're looking at the rest of the world. Again, some of those third world countries we talked about. We're not the only pig at the oil trough anymore. Okay? We've got China. We've got India. Obviously Europe. And then we have those emerging countries that we talked about. Look at this chart for a minute. The United States is in yellow. China's in sort of an orange-red. You can see back in '02, not a million years ago, China barely showed up at all. That little orange, that red, whatever, barely showed up. Then you can see that red, how it's really jumping. And not only in '08, but you can see it really jumping in '12. Look at what a big piece of that is. The United States, we had tremendous consumption, if you will, in oil, natural resources, etc. in '08, but you're seeing we're really cutting back quite a bit. Okay? Not getting, we're using alternate energy, what have you. China, really big jump with the European Union, but a really big jump with the sort of beige color with the rest of the world. So again, we've got a limited natural resource, and a lot of countries want it. That's going to drive the price up. That's going to drive the price up of everything. Because why? They have this middle class. They have people that want to consume now. The world is developing a middle class, and they're looking at us. They're seeing what we have, and they want it too. And you can't blame them. Everyone wants a better situation for their family. Everyone wants a better future for their kids. So this is the outlook of what we're looking for. And again, talking about Africa, as I have the last couple of sessions, Africa has a lot of fuel, natural resources, oil, gas, metals, gold, copper. All of that needs to be developed, and it is being developed. Okay, so there's tremendous growth that we're looking at in some of these countries. Does that mean we should jump whole hog in mutual funds that invest in this? No. But beyond just the U.S., we can have sprinklings into some other areas where you're going to see growth. That's called diversification. And of course, we rebalance to make sure that we don't become more in one area than we plan to. So I want to thank you very much for listening. And if there's one takeaway here, I want to quote Warren Buffett. He said, ketchup is forever. Okay? And the problem of what he's seeing and what I see, and most economists are seeing, we're in a low interest environment. So we have to look at something that's going to return real money, keep our purchase power up, beat inflation. And that's why you're seeing some of this jump in terms of what the stock market's doing. Will it always jump up? No. And history shows that. But it also shows that when you have declines, you also have ups. So you need to take the long-range view in terms of your financial situation, and then we select what would meet those needs, specifically to you. Thank you very much. I appreciate you listening. Certainly call my office if you have any questions. Thanks.